All right, guys, welcome back to the Independent Investor Channel, a portfolio review of my self-directed Roth IRA account number 2. This is going to be super important for you to guys understand how I mirror these two accounts against each other, and I really build them to complement each of the holdings within each of the accounts. Okay, this account is going to be funded this year as well as the other one. It is approaching 100,000, not quite there yet. We should get there in 2020 if market conditions are favorable to continued capital appreciation within the account. So I'm excited to see that second account surpass that six-figure mark. It'll be really awesome to see that. But this is my other flagship account. This is comprised in the same manner as the Roth IRA account number 2, with the passive base in mind, with those good blue chip dividend paying stocks there that are all housed within the tax protected Roth IRA account, and it's also allowed to grow unobstructed, wealth preserved within that account because I don't pay any fees to invest in the manner that I do. So I'll drop you in the account now. Please enjoy the review. All right, guys, so it's my pleasure to roll out these portfolio reviews to you. This is a Roth IRA account number 2. This is what is built to be a complement to my other self-directed Roth IRA account. I would consider this another one of my flagship accounts here. I'm going to run through the list quickly so you guys can understand some of the positions that we've taken in this portfolio here, some of the rationale behind it. You're going to see toward the bottom of the portfolio that it's more centric around some of the passive ETF positions. Toward the top here, we've got AbbVie in the healthcare sector. Took that for a few trading profits in 2019, but this is how we rounded out 2019, and we're holding this relatively smaller position than we did on the trade in 2019 in AbbVie. The next is BCE. This is the newest position in this portfolio. This is the Canadian telecom play, a little bit more geared toward leveraging the 5G opportunity. You guys will see as well at the bottom of this portfolio, we do hold Verizon, so VZ in the US, and ticker symbol BCE for the Canadian telecom exposure. Next on the list is Cisco, ticker symbol CSCO. Cisco is the largest technology holding in this portfolio. Good dividend payer, over 100. I'm satisfied with allowing this position to go ahead and continue to work here at just over 100 shares. The next is Corteva. This, for you guys that have followed me, was as a result of a triple split of Dow DuPont at the time. Dow split and offered shares of both DuPont, Dana Moores, and also Corteva here. So that's these three names here. And actually, when they split, the percentage of loss here was actually kind of generated within the split. So I know it appears as if these are down pretty heavy, but these actually started when they split off, and so that's where this reflected loss comes from. I don't believe the realized loss is that significant. So we'll continue to hold. We like all three companies actually. They're quite good, and they're not hurting anything. They're good dividend payers, and they're accumulating shares as they kind of find their place here and start to work for us again as an investment. We'll go back up here. I skipped over Chevron to talk about the three after they split, but Chevron is the mirror to the other portfolio, which has Exxon. So I've split the majors, that of which I feel like are best in breed and energy. Definitely excited about watching this position perform this year. We'll see how energy shakes in 2020. Relatively small position in this particular group of stocks. Relatively small. It is the only energy holding I have in this particular grouping, which is fine. But nice dividend payer to boot anyway, so accumulating shares nonetheless. So drop down here. This is also one of my newer positions. I've owned Duke Energy many times in the past. Not ecstatic about the price that we had to pay for the shares. It's overvalued certainly, but absolutely stoked about the dividend, which, if there's any one singular focus in this particular grouping, it is the dividend yield, with also providing some passive ETFs toward the bottom end. So really try to take a little bit more of a concerted effort for a conservative basket of stocks within this portfolio, and I believe we're achieving that. We'll continue to evolve it over time, as I do with all of my portfolios. I'm constantly monitoring it, making sure that there's not room for improvement. Home Depot, say no more, finest company as far as I'm concerned in the home improvement space. You're going to see that I do own Home Depot and Lowe's. Lowe's is probably a better buy in my estimation. I think there's probably better value in Lowe's right here. As a matter of fact, I know there is. But Home Depot at 10 shares was fine to add in here. It's totally fine. A Dow, good, nice Dow component, and to get some exposure to the discretionary space in these two names. I was fine with owning two of them. As a matter of fact, I messed up and hit the buy button. I meant to split them up through the portfolios. I typically do not do that, but we'll see what happens. We got a good entry on Lowe's. We're up just fractionally in Lowe's. We're fine. We're going to continue to own these because Home Depot, it is my personal favorite, but from a valuation perspective, I do think Lowe's is probably going to look to really have a good performance going into 2020. So we'll see what happens there. You guys know my thoughts on Honeywell, and in the industrial, this complements a holding in United Technologies in the other portfolio, which we've just taken some profits in, I might add, and looking to reestablish a nice position in Honeywell, which I actually think is a little bit better buy at this point than United Technologies. And then right below it, one of the stocks you can own forever, JP Morgan Chase. This is the biggest financial position that I do have in this particular grouping, and largest bank in the world. We're fine with owning this here. Nice dividend payer, relatively large position, but nothing too crazy to get me a really nice cornerstone in the financial sector. So right below it, Kraft Heinz Food, another nice dividend payer here, and we'll continue to monitor that into 2020 and just see how that performs. Lowe's we've already mentioned. 3M is coming back. I knew it would. I knew we would probably see 200 before we saw 150. I know there was some subscribers that were really hoping for a little bit better entry on 3M. You typically don't get a whole lot of time to sit there and think about stuff like that, and 3M gave you a couple months. But if you deliberated too long on 3M, I think you missed your base there. As it climbs back toward 200, I think it will. It's been performing quite nicely. I didn't really care, quite honestly. It could have stayed low for much longer. Wouldn't have mattered to me, as this is one of the industrial cornerstones. Industrial's one of my favorite sectors. I do have really nice broad exposure through industrials, but 3M absolutely foots the bill there. Merck, I believe, is getting a little bit stretched here. That's fine. Nice dividend payer, one of the premium plays in the healthcare sector. We've owned this a while, relatively small position, and we've just watched it run up a few bits, just south of 6% appreciation here. Realty Income, and that's a relatively new position, I guess, maybe a month old or so. We got a good entry on I thought it was overpriced when I bought it, actually. This is really kind of to test the waters, and I'm continuing to do some study up on Realty Income to really grasp and understand the business and what they do, and what type of systemic risk could be associated with owning REITs in general, to be quite honest with you now, with the real estate market showing some signs of cracks, in my opinion, based on what I see. But we'll continue to hold Obviously, it's a dividend favorite amongst the group here, and I'm glad to own it. That's fine. 30 shares in that in O Realty Income Corporation. PepsiCo's been in this portfolio for an awful long time. It did quite well. It performed well in 2019 for us. Right below that is Pfizer, which I think is probably the best value right now in healthcare. 104 shares. That's dividend reinvesting quite nicely for us. We'll continue to monitor that as we grow that into. This is the largest position in this particular grouping, Johnson & Johnson being the good complement in the other portfolio. Right below it in the financials is Prudential. It is my only insurer, north of 4% dividend payer here. Still quite undervalued. I've made a pile of money with this in 2019. Probably just could have kept it, but took a few swings, watched it come back off of its price run. So locked in some really good profits and then reestablished a 25 share position here, as I do consider this stock and company very undervalued still. It's got really a lot of room as far as its fair market value. So we'll watch that. I'm underweight financials, so this helps going ahead and putting an insurer into the portfolio. I'm actually excited about a couple other insurers, Aflac being one and AIG being the other, but I don't own either one of those. We opted for Prudential. Raytheon in the defense, this one kind of stands on its own in this portfolio. Defense subsector here, so gets this some defense exposure. Starbucks has just been on fire. It catches these waves, and this company is really in favor right now. For all the scrutiny that it gets when it's under the microscope about falling in between growth and value, it's seemingly back on the growth train right now. I don't know how long that's going to last. We get a slowing in the economy, and you'll watch the discussion flip on a dime with regard to Starbucks. So we may take this into a trade and rotate this out of the portfolio. Certainly up 9% with less than probably a month on this position. I'm totally fine with taking my 10% profit and moving on, as I think valuation was stretched when I bought it, and just kind of took a stab at it to boost up my discretionary exposure, and it worked out. I was willing to take the name long into a downturn, but lo and behold, we tripped and we fell and we made some money in Starbucks. Really one of my favorites, to be honest with you. This makes a short list of some of my favorite discretionary names out there anyway. AT&T I've had for quite some time. We trimmed a little bit in 2019, as this portfolio does have some pretty good heavy weight to telecom, which is fine. Toronto Dominion is another Canadian financial company that we own. It's a Canadian bank, good dividend payer, good solid company. We'll continue to own that. We'll skip over United Health Group. That just ran up. It took a huge trade profit in UNH. That was a really nice one in 2019. Then down to Visa. Visa's a cornerstone in the fintech sector here. So really, I cannot complain when it comes to holding Visa. It's been quite nice for me in this portfolio. It's performed well. And toward the bottom here, we've got Verizon, I've already mentioned, in the telecom, Wells Fargo in financials, Waste Management here in industrials, relatively small position in waste, and then the bottom end of the portfolio here with Walmart with a rather large position in the staples, which I'm a little bit overweight right now, which is fine. I really don't mind establishing a nice position in Walmart as a single stock holding going into some potential volatility in 2020. That's just my thesis, and I'm sticking to it. The passive ETFs in this portfolio are quite simple. You guys can see here the Vanguard's S&P 500 index is the largest position at just over 10,000. It's performed quite nicely. I have had the chance, and if you can glean some of my insight on owning some of these are just an absolute pleasure to own. They really are. They're easy to own. They're easy to be an investor. And for you guys that look at some of these holdings and, down, red, single stock investing isn't for the faint of heart. It can be very tricky, can be very humbling, and most people, quite frankly, will underperform the market. Now, a lot of these positions that you see are down are, you don't really see the whole story with these, because a lot of these were bought with profits rendered from other holdings that I've actually taken swing trades in. A lot of that profit I've been able to leverage and build up positions like you see here as I move the portfolio a little bit more toward that 25%, 75% mix that I'm looking to establish. But VOO, 35 shares in VOO. VEA for the Vanguard's developed, which is the European ETF here. $4,500 in there. And finally the small cap. This is the small cap growth in here with VBK. So a nice complement to the VOO in the S&P 500. So hope you guys appreciated this. Took a little more time on this portfolio review, keeping it simple. Don't want to get too in-depth on these. I think some of the real takeaways from understanding and viewing a portfolio like this over the comforts of YouTube are to understand some of my strategic goals. We talked about that in one of my previous releases. Super important to watch this and see what an actual live portfolio looks like, but you can pull out little aspects to say, look, I like why Ryan is explaining Walmart going into potential volatility. I like the insistence on some dividend payers in the portfolio, Pfizer, 3M. I like the justification between Lowe's and Home Depot, etc. But if you don't like that angle that I take with the single stock, the style of entering into passive ETFs like this VBK, VEA, or VOO, those three right there could be an entire portfolio. Get you nice diversified exposure across the broad indexes, and get you a little bit of dividend income to boot. So really just a fun way of investing. And just finally, I will say that all of these holdings are housed within the self-directed Roth IRA account. So not only are we enjoying the tax protection over every penny that's paid to me via dividends, every trading profit that I ever render in this down to the penny is tax protected. And furthermore, since it is a self-directed account, there are no fees attached to this particular account as it's self-managed. So all the profit that's rendered within this portfolio, just closing in on 100,000, are mine. I don't share it with anybody, which is what I would hope to wish upon anybody that makes their way to the message here and understanding the benefits of self-directed investing without the assistance of a financial planner. So guys, with that, thank you so much for tuning in to the portfolio review. I'll kick you back to YouTube now. Thank you very much. All right, guys, welcome back out of the account. I hope you enjoyed this portfolio review. I love providing this transparency to you guys, man. I would have loved to have had the opportunity to see what an established portfolio looks like, especially if I was a new investor. I may not have understood maybe all the ins and outs of what I was looking at, but it's powerful. This is a real account that I've built up over the last 15 years or so of building this account the correct way. And I would only contend that the real takeaways for you guys is to understand that there is a correct way. You can really eliminate a lot of mistakes by getting involved in the market in the right account, getting involved in the best quality assets out there that you can. If you don't understand single stock, search out the opportunity that's made available now through the passive opportunity, whether it be through index funds or exchange traded funds. It's never been a better time to become an investor. And just in 2019, they've dropped all fees to enter into some of these names. So before, when we had to pay for our entry and exit of some of these equities that we were buying, for the new investor, it's free of charge. There's really no excuse anymore to not have some level of exposure of your net worth in the stock market as an investor. So guys, don't hesitate. Hit the subscribe button. Help me support this message that we're putting through on the channel. You're going to want to share it with anybody that you know that's looking to get some information on the stock market, basic wealth building principles, looking to get involved for the first time. We can really help them out on the channel. Leave your comments at the bottom of the video. Thank you so much for tuning into this portfolio review, and good luck in your investment future.